Welcome everybody to another edition of XPS News. I'm Simeon Willis, CIO of XPS Investment. Today we'll be covering the current market outlook across a range of asset classes, with expert comment from our guests, Clive Emery, multi-asset strategist, Invesco, and Remy Oli Pitan, multi-asset portfolio manager at Schroders. Welcome to you both. The markets have experienced the steepest sell-off since 1987, but the extent of the fall has not yet come close to the overall peak to trough fall we saw when the tech bubble burst in 2001 or in 2008, the financial crisis. The impact on pension schemes has already been substantial, with funding levels falling by around 10% over the last month. But what's left to come? The situation presents a challenging set of circumstances for pension scheme investors as they try to evaluate their current investment strategy and the choices to make in the best interests of their membership. So let's get stuck in. Clive, we've seen equity market falls of between 20 and 30% in the last month, but the outlook for the coronavirus disruption is still not clear. What sort of scenario is the market currently pricing in terms of when we can get back to normal?
I think that question encapsulates a few issues. One, what is normal, and will normal be what we see as we come out of this crisis? We have seen with our team a number of concerns, a credit concern in the US specifically and in China, some concerns over valuation. And we have also started to see obviously this medical concern. And as that tide has rolled back, some of these other concerns we think will come to the fore. So trying to formulate how long the medical crisis will last is a question that is clearly difficult to answer. And you can see this in earnings. Earnings forecasts for single stocks in the US have never been as dispersed as they have been over the last 20 years. And that tells you that the market outlook that people are forecasting is incredibly broad. There are a range today, I think, from major brokers from -5 to -50% of earnings. That level of uncertainty is what is driving the level of volatility. It will also, I think, continue until greater certainty is provided.
Thanks, Clive. Remy, being the biggest component of the global equity market, do you think the US market has factored in the GDP impact of a UK-style lockdown?
The US market has factored in a slowdown, so a disruption, but the US market hasn't factored in the GDP impact. And going back to Clive's point, the reason why it's difficult to factor in the GDP impact is because nobody knows. We're dealing with a medical disaster here. And the challenge is nobody knows what the duration of the lockdown will be. Certainly Trump doesn't know that. I think at the moment, what we're seeing is that the US market is factoring a slowdown, certainly in the first quarter and the second quarter. But interestingly, the market is factoring in a V-shaped recovery. Now, a lot of analysts use a lot of letters to describe recoveries. We're hearing of V-shaped, W-shaped, U-shaped, L-shaped, and that just tells you that nobody knows. So at the moment, the market has factored in a degree of uncertainty, but there is still a lot of unknowns. And so we expect the market to remain very volatile.
Clive, if clients are looking for a safe place, how safe are investment-grade corporate bonds, given around 50% of the market is BBB?
We think investment grade remains, given the backing of QE, a safer place to be than high yield, and also a safer place than equities. Some of the defaults being forecast at the peak for investment grade had never been seen before, and most investment grade companies today have good long duration exposure on their balance sheets and look safe. In terms of high yield, and especially private credit, as a team, we have had ongoing concerns for 2 years, and this sort of medical emergency is starting to demonstrate the problems that we think lie on corporate balance sheets, especially in America.
Thanks, Clive. So, Remy, with monetary and fiscal stimulus on an epic scale, is inflation the biggest risk to fixed income investments?
Inflation is a big risk to fixed income investments, but I think there's a time gap for that. So, for example, right now, the market will focus on the economic impact of COVID-19 and the fact that oil prices have collapsed. These are all deflationary. So for the time being, certainly this year and next year, deflation will be center stage. I think when we think about the long-term impacts of fiscal deficits globally, then there is a case that inflation expectations should rebound. But for inflation expectations to recover, we need to see economic growth recover. We need to see the labor market recover. We need to see oil prices and commodity prices recover. So I don't believe inflation is an issue for us now or for the next few months. Maybe towards the later stages, yes, but not now.
So could I add to that in agreement? We have taken the view that the sort of the fiscal stimulus that we're seeing, which historically can be associated with periods of inflationary pressure, at the moment are here to support the fall in aggregate demand, to mitigate the fall in demand, not to necessarily increase it. So we're seeing these bazookas as a support mechanism, as a band-aid, and therefore, to agree with you, Remy, to see that as a deflationary impulse, or preventing somewhat of a greater deflationary impulse, but we don't see it as an increase to aggregate demand, as you might expect. When people talked about World War II, people were being paid to mobilize, whereas today we're being paid to immobilize and to stop the economy. And they do, we think, have very different inflationary impulses.
And Clive, on a related point, what has led to the sterling depreciation, and is now an ideal time to hedge overseas foreign exchange risk?
Well, we've seen, obviously, with sterling for some time, the themes at play have remained similar. So we have the twin deficit, the fiscal and current account deficits. We have a very open economy here in the UK. We've obviously had concerns over Brexit and the implications there. And in addition, we've had, obviously, rates cut to zero. And that obviously has weakened the currency. Now, sterling has acted very much as a risk-on currency. So obviously, as markets have fallen, that tends to have seen. I mean, we fell down into the low, 1.1s, and now we have bounced back into the middle 1.2s against the US dollar. It depends in the question is it a good time to hedge? Because I wouldn't necessarily say that any of those fundamental factors driving weakness have diminished. But the question is, what are you hedging against? Clearly, if you are hedging your foreign currency exposure against maybe some EM countries where dollar funding pressure continues to continue, and that the COVID crisis might be more impactful, then hedging your exposures there might have greater relevance. Whereas if you're hedging it against maybe the dollar, you may find that the trading range we have seen over the last 2 to 3 years perpetuates. So I do also think the question depends what you're hedging and where.
Thanks, Clive. Remy, are you seeing any operational issues in the market, and should we expect liquidity to get worse?
Yes, I think, certain asset classes are trading at distressed levels. And part of the distress is a function of the fact that trading is dysfunctional. At the moment, it's very difficult to actually trade certain assets. So this is true illiquidity. The key areas where we're seeing dysfunctional markets is still in credit. The Fed and other central banks have tried to alleviate that, certainly in the case of investment grade. But other areas such as high yield is still dysfunctional. And the challenge is, I think what we're seeing is that if we look at corporations, there is a real struggle to get access to dollar cash. And so if you can't access dollar cash, it's creating this dysfunctionality. A lot of strong corporates that usually access funding through commercial paper, we can see what's happened to commercial paper spreads. LIBOR or OIS is all over the place. So the market is still, there is still a lot of illiquidity. Now, in the case of multi-asset funds, this isn't a problem because we have a number of asset classes, and the way we run our portfolio is to to have liquidity. But I think for single asset class areas, particularly in the credit space, there are some issues in terms of trading. And typically when we talk about trading, we don't mean selling alone. When I speak to some high yield managers, they're actually struggling to invest capital as well.
Thanks, Remy. And on a related area, the property market has struggled with liquidity. What's your view on how the UK commercial property market might stack up against other asset classes, given the scope for rental defaults to materialise?
I think that the next few months will be challenging for the UK property market in terms of fundamentals. As you mentioned, we're expecting to see a lot more defaults, particularly on the rental side. The commercial property market is highly exposed to the retail sector and to the high street. And so it will be a challenging few months. Valuations at the moment are not suggesting that prices or commercial prices are reflecting that issue. And the other struggle with the commercial property market, as you mentioned, is illiquidity. Now, what we are seeing is a lot of property funds are suspending dealing. So it's actually difficult to get in and to get out. So for now, we think that although property has a place in a number of diversified portfolios, this is the time for investors to be patient. Given the kind of market environment we're seeing, liquidity is a premium and liquidity matters. So I think investors need to be a little bit more patient, to continue to observe what's happening in the property market, wait for valuations to improve, wait for liquidity and trading dynamics to improve before revisiting that asset class.
Thank you. Clive, on a slightly different area, does portfolio insurance using equity options offer scope to protect a portfolio, or is it simply too expensive?
Well, yes and no. So the view on equity and options specifically is that they have been a fantastic way to protect portfolios during the current crisis. If you were trying to start today to protect your portfolio, that would be quite expensive given the level of volatility. So we have always looked at volatility as an asset class, and obviously volatility is a lot higher today, so that does make, on the protection side, things more expensive. However, we look at volatility, given as we're a multi-asset fund, across a range of different asset types, not just equities. And so we try to find different ways to protect portfolios, trying to find, as you would in any other asset class, areas of opportunity that are less expensive than in other certain areas where equities are relatively expensive.
Thank you very much, Clive and Remy. We've covered a number of different areas there. I think what stood out for me is the uncertainty that we face in terms of the impact on GDP and the scope that weaker companies can be particularly affected by the impact of this crisis. And that deflation is the near-term concern for markets, with inflation perhaps being something for further down the line. So the key things for pensions to do is assess their current situation, engage with various stakeholders, and act on those discussions. And we'll keep you updated with developments as they emerge. Thank you very much.